Okay, welcome again to this Zoom meeting. So today, um, I would like to share something about trend trading and structure trading. So here's our lesson plan, and this is how we are going to move on this lesson plan. First of all, we must understand uh, the structure. So we'll start with the structure, and the rest will follow. So before I start, there is something I want to make it clear to most of you guys. I know there are a lot of preconceived ideas about Forex trading, which makes you to not understand the real meaning of trading. Okay, so we are probably talking about, this is an introduction. Which makes you to copy and paste stuffs. What I'm trying to say right here, it's most of the people, based on different methodologies that they are using, they most of students who go to learn those methodologies, they don't go there to learn, but in the end, they just end up copying and paste each and everything that the method is trying to tell them, which is, as a trader, it's kind of a very bad action that you could do in the market, because we always act depends with the price reactions in the market, and we don't um, call moves, or we don't call moves in the market depends on what the strategy says. The strategy can say something, but the strategy is only giving us a foundation of what to look for when it comes to the market. But what you want to do, or what's your reaction when you see those things, it's something different. Your react depends on a price reaction. So most of the strategy, I don't know. I'm sorry if I could mention a strategy that you're using or stuff, but you can see a lot of stuffs. They could say when you see something like this is a area of liquidity. When price reach around this level, you're supposed to enter the market and sell and put your stop loss above here. Other strategies, they teach you, I don't know, patterns. You know, when you see something like this, when price touches here, you enter buy and go to the top. I mean, you enter buy, or when you see something like this frag right here, I don't know how to draw them well, but I guess you get my concept. All these concepts, I'm not saying they are bad concept, but what I'm trying to say is you cannot copy and paste each and everything that the strategy is trying to tell you. What you're supposed to do is understand the real price action, the real price reaction that you see on a current market or on a particular market. What does price show you after it reacts around this level? What does price show you when it reaches these areas of liquidity? That's the thing I'm trying much to explain here. Um, you know, when you are into a certain mentorship, you are with a mentor when he's trying to show you in the real charts that look right here, price reached this level and it sold. You know, when you're with a mentor, everything that a mentor told you, it works. You know, when you go to the charts, it works. But the the real problem come when you are trading live funds. You know, a lot of people, they just struggle to come to master their craft when they start depositing. But when they trade with the demo account, you could see them performing well and stuff. But when it comes to live funds, the story changes. Why? Because first of all, you didn't understand the real meaning or the real thing behind the price action. There's this quote I can say: They say same price, but differently, different view. Me and you, we could see the same price, but how I'm going to view this price and the way you're going to view the a certain particular price, it's two things different. Why? Because on my level of understanding the price and your level of understanding the price, when it comes to the market, you are supposed to treat the market. Now, this is the answer to what I'm trying to tell you. When it comes to the market, you are supposed to treat the market. When it comes to the market, you are supposed to treat the market in terms of buyers and sellers. So we come to our early now we come to our early stages in Baby Pips, where we in the introduction of Forex, they say Forex is a market, blah blah blah, and it involves a certain participants, blah blah blah. These participants are the one who will they move market, blah blah blah. So stuff like that. When it comes to you understanding the structures, you understanding the market, what you're supposed to do is understand the market, view the market in terms of participants. When it comes to participants in the market, when it's come to participants in the market, you know who are the participants in the market. They tell you there are banks, okay? There are banks. They tell you there are hedge funds, big hedge funds, okay? They tell you there are us retailers. These are participants in the market, retailers, okay? And so on and so forth. Other participants, you can name it. Government, you know, government, how government involved through central banks. Okay, central banks. So when you combine all these participants, they only do two things, either one or the other. Okay, they only buy or they only sell. So when it comes to the market, which you already know, you have these participants, you're supposed to view the market in terms of buyers or sellers, the main participants in the market. So how buyers react and how sellers react. So when price is at the level that you call your area of liquidity, how does those buyers around area of liquidity react? How does those sellers at area of liquidity react? Are they showing you they have momentum? Are they showing you they are losing momentum? So what you do, you're supposed to do when you see sellers around area of liquidity when they are losing momentum, what's your reaction? Okay, these are the things you're supposed to ask yourself and answer yourself at the same time. Now, I will show you the part on how to answer these questions, and I will show you the part on how to observe these things in the chat. But in the meantime, I'm supposed first to make sure you understand what I'm trying to tell you or to view with you, to share with you my views on how I analyze these charts. Okay. So the only thing that these strategies tells you or show you is they just make you to copy and paste on whatever they're telling the strategy is saying. And at the end of the day, you become part and parcel to that strategy. You become what I call is like a slavery or something, because you cannot do until you recall to the strategy what it says. It's a good thing. That's why at first I say it's not for the bad thing, but it's a good thing. The only thing I see it's wrong, it's you to say like, I'm waiting for this price to reach here and I will say, no, it's for me, I'll not sell here. I'll wait to see price give me criteria for me to sell. So this point is not an area to sell. It is just a bearish level. because why I say is this level is just a bearish level, because how could you answer this? For example, you said, I wait for this price to sell right here. So what if price comes to around this area, touch this area, retrace a little bit and break to the above? Would you call this whatever you call it? No, the answer is no. You'll start coming up with other supporting evidence, like okay, prices just break this level and blah blah blah, I'll do this. No, the first thing in the trader, what we are supposed to do is, price is around an area of liquidity. Fine, I'm going to sell or I'm going to buy until price give me some real reason on how to take this reaction that I want to take, either buy or sell. So that even when price break above this level, you could conclude that price, it didn't give me clear reason on selling this pair. Why? Because I saw when these buyers were approaching this level, these buyers were still maintaining their bullish structure. They were not breaking previous structures. So since price is showing that these buyers, they are maintaining their bullish structure, which means these buyers are still strong in the market. You will see sellers, because what? Price is not a straight line. Price, it goes up, it goes down, it goes up. That's how it moves. So you see some retracement. As long as this low gets respected, these buyers are strong. So that, so that's how you see a strong push to the upside. Why? And not price coming around this level to continue selling, because these buyers were still strong in this market. They were still respecting these lows while they were breaking these highs. Okay, so this is how you start, as a basic, as an introduction. And this is what you're going to use daily. First, translate your structure, your market, in terms of buyers and sellers who are in the market right now, who are fully participating in this market, and who are not fully participating in this market. You go along with those who are fully participating in the market. And those who are losing momentum, you leave them and you join the other side. Okay. There are some strategies say you trade like banks and stuff. You cannot trade like banks. Banks are different, because banks, they can do whatever it takes. No. Let's say, for example, this is the price level right here, and this is the price level right here. So price just came around this level and start moving to the upside. Okay, break the structure, comes below it, respect the structure, start to move to the upside. Right? There's a theory of time and price. It always says that we know the price, but we don't know the time. Okay, you know the price is bullish, but you don't know when as this price will come and reach this level. That remains mystery. That remains something we don't know. We only react on what price it will show us. Okay, so these are the big banks. They are buying this pair, for example. Retailers also, some smart retailers, they join the buyers. Okay, there are other retailers, they see this market as a retailers could view this market as prices giving us highs, lows, highs, lows, highs, lows, highs, lows, highs, lows. Okay, so they are buying here, they're buying here, they're buying here, they're buying here, they're buying here. These are retailers. They see there's a structure break, they buy here. They see the price respected, they buy here, right? When these market makers, you call market makers, you can trade along them. When they reach a level, they want to book profit. You know what they did? After they book profit, they leave the market to retrace a little bit, to remove those participants. When they see there's a huge participant in this move, they retrace a little bit to remove those participants. What does this retailers see? They will see that price have just break the structure, and now we are changing the direction. Now we are going to the downside. They start selling, selling and selling and sell to the downside. When they see they have just booked enough profit, know what they do? they move this market to the upside. Now sellers who are the early sellers, they get some whips, they get out. Some they start blaming, oh, it's a stop once, it's price manipulation, spread and stuff. When you know something, when you know the market, there's nothing like spread, there's nothing like coat. Why? Because you'll know exactly where price is heading. And price is always seeking what? This one thing, liquidity. Price is always seeking liquidity. Buyers and sellers, they always seek liquidity. When the liquidity is not there, you not see buyers and sellers. When the liquidity is there, you'll see buyers and sellers. Now, what's the answer of this retailer knowledge? I always told people that it's not all the break of structure means the market's supposed to change. Some break of structure means price is seeking a certain liquidity below the level so that it could move to the upside. So sometimes price is just what I call price is coming to, yes, price is coming just to seek the liquidity. Okay, it's doing something you call exhaustion and then continue to the upside. Along the way, we are when we are continuing with the lesson, there are some other concept I will review to you. It's not concept that you're supposed to copy and paste. No, some ways that I've just tried to see in the market, and I'll explain to you in detail so that even you could take what I've just saw and practice at your own and see how it works and develop a certain rules along with. A good thing or a profitable trader, it's the one who take the concept or the method and develop rules alongside it. I can say those who are using whatever they call it, smart money, or along all the strategies that you could hear, they are not making money. They are making money. Why are they making money? Because they have mastered the method first, and second, they have already developed some rules along that method, which helps them to filter the noise. So, but the other person who have not developed the rules around the strategy, he trade each and everything he sees. That's when you see people complaining about maybe a broker or the market or the news. There's nothing wrong with the market. There's nothing wrong with the broker. We always say the market is always right. When you see any movement in the market, just know the market is right. The market is never wrong. The one who is wrong is the trader himself. Trader himself is the one who is wrong because he's the one taking the move against the market. Okay. Yeah. So you can ask yourself, okay, price buyers and sellers, they seek liquidity. Now, this liquidity, how does this liquidity this liquidity, they come in form of orders. Okay. Now, before we go to how this liquidity comes in terms of what we say, liquidity come in terms of orders. Okay. Before we jump to that, you can ask yourself, or you may be asking yourself these questions: why the market moves, and why the market moves. Okay, why the market move. This is a question you can ask yourself. And the second question you can ask yourself is, where is it going? Where is it going? Okay, where is it going? So the answer to this question is these two questions. The answer to these two questions is liquidity. The market moves because of liquidity, and the market, where does the market go? It goes where the liquidity is. So, and how this liquidity, you can be viewed, this liquidity comes in terms of orders, like I say, in terms of orders. Now, these orders, they can be buy orders or sell orders. Okay, so price move to follow the orders. Now, when it comes to now the structure, what does the structure give you? Oh, this is the thing that I always told people that the structure only offers you with two things. Market structure offers you with two things. Let's say this is the continuation market, okay? So the continuation market structure offers you with two things. First thing, it offers you with validation, and second thing, it offers you with invalidation. So this is validation, and this one is invalidation. Invalidation. So when the market breaks this structure high, when this market breaks this structure high, and it closes above this high with a full candle closure, say that price have just validated a bullish structure. So a bullish structure is validated. Here's the point where you see some retracement coming inside this whole structure. You say this is an area of liquidity coming inside this structure, and price move to the upside. Now, what if price give you validation and move to the downside, to the invalidation, and breaks this level? You can ask yourself. You said price give structure offers us with two things: validation and invalidation, right? What if when price fails to cross above this structure high and come to cross below this structure low? Say price we consider what we consider body closure above this structure high. Now, when price fails to cross above that high with a full body closure, and it closes with a wick, say price have not break this structure high. Price have not break this structure high. So if price does not break this structure high, price probably will come below this structure low. Now, when it comes to this structure low, we believe price is coming to seek liquidity. But when price comes to this structure low and close below this low, we say that price have invalidated the bullish structure. Price have invalidated the bullish structure. So when price invalidate the bullish structure, which means we'll start seeing what? Some bearishness going to the downside. Some bearishness going to the downside. Okay. Yeah. Now, what are the things to look on? But before that, you say, let's say for the market, which is changing, price have just break the structure, and price have just invalidated this structure. For a reversal market, the same goes with the continuation market. Also, price offers you with two things. Okay, you will see price validate the structure, and you see price invalidate the structure. Okay, which is price it will be changing the structure. Now, before you start engaging to yourself, now here is an additional thing when it comes to a reversal market. After price invalidated the structure, you wait first for this structure to be for this reversal to be pure, or for this shift to be a pure shift. Pure shift is when price give you the first swing high and swing low, and which is valid after price validated that swing high and this swing low. The first swing high and the first swing high and swing low. After price validate this structure, that's when you engage in the market trading. This will become your new area of concern. So you trade around this area of liquidity. When price comes inside this area, then you trade your sells, put your stop loss above that, going to the downside. Okay, now let's try to see in the markets what I'm trying to tell you. Okay, here is DXY. Here's a DXY. Yes, DXY. We had a move on a DXY. Like I always, we had a move on a DXY, which is let's start from this structure here. Price gave us this low and this high, this low and this high. So which means price validated this structure high by closing above it, and then this low became an invalidation level where it will be invalid if price will trade below this level and continue to the downside, right? Now, after price validated this level high, you know what did price? It traced to the downside and continue going to the upside, which means it validated the bullish structure. Now, what are we anticipating? We anticipate that price will maintain the bullishness going to the upside. Price will maintain the bullishness going to the upside by closing above this high. As you could see, price close above this high and continue maintaining the bullishness going to the upside. I mean, going to the going up. But now you can see why we started to see DXY as a bearish. You could see how price was reacting. Price action, price reaction. I'm always saying this: price reaction. You trade based on price reaction and not what you see. I've told you, like, price when it's validate, you trace to the inside and goes up, right? But after price validated this level, we expected what? We expected a liquidation inside here and continuation to the upside. Okay, but observe how price started to react since from Monday after just validated here. Price gave us what? This liquidation inside, and it gave us a new high, gave us a new low and a new high, and then broke those structures. So which means price, it gives us a new things to look at in the market. Price validated the structure, invalidated the structure itself by changing the momentum from bullish to bearish. So which means this bullish, this bullish liquidities or these bullish participants who are found around this level, they are no longer valid until they are going to be valid until we see these sellers, they fail to push this price going further inside this area of bullish liquidities. Now, here's the thing. Price validated this structure. We expected what? After break of structure, it's a liquidation to the inside, right? Yes, price gave us this liquidation and sell to the downside, breaking this structure low. You could see I marked this level. This is structure low. Then after breaking this structure low, we expected what? A liquidation inside, then a sell to the downside. But price, you could see the reaction in liquidation, a liquidation, then this low and this high. So you could see again, price started to change structure within structure. Price shifted. If you go to the H1 time frame, you could see it clearly on H1 time frame. We had an H1 structure, price broke this structure on H1 time frame. So which means this liquidation that we expected from here fails to continue to the downside. So what price did, because it failed to continue to the downside coming to this level, so which means price pushed to the upside. And then solid. Okay. These buyers who entered in this market, because already we are anticipating a change in structure. As you can see, it broke above H1 structure, so we anticipated a move going to the upside, going up, but we did see price failed to close above this structure high. The first structure, the first high prior to this swing low, failed to close above this high. Now, if it fails to close above this high, we expect what? Because price did give us high, low, high. We expect price to come and close below this low and give us a liquidation inside and continuation to the downside. Now, this is how we were we're analyzing DXY. DXY, this is how we were analyzing by following how price were reacting above the high and below the lows. Now, price have already broke this structure. What we anticipate that we could expect a liquidation inside before continuation to the downside. Like I said, after a shift is supposed to be matured. So a matured shift is when price give us the first swing high and swing low to this downtrend. So price, we expect this break structure, then this liquidation to be a trigger for us to continue to the downside and seeking more areas of liquidity to the downside. But in the meantime, what we are seeing is a bearishness in the DXY. So if we see bearishness in the DXY, which means in other pairs which have USD as their benchmark, we'll see some bullishness. Now, the only thing that remains right here, because this is the true high and this is the true low. Price failed to close above this high, we expect price to close below this low. Now, if price will fail to close below this low, which means we are supposed to see some changes in H1 time frame of us triggering us to be bullish. If not, that means we'll continue to hold our bullish moves on our pairs that we have already traded. Okay. So if you just follow through, price always give us with two things, and always price reacts. This is one thing that I told people, like, forget about the big words that you hear in the market. Those big words that you hear in the market, always price reacts in a support level and a resistance level. But how you treat those levels, that is how it's going to differentiate you with the rest of the majority. If you treat those levels support or resistance level, like the level to enter in the market, like for example, this was the resistance level, because you can see price was resisted here and came around this level and this level. No, now this becomes a resistance level. If this is the resistance level and just because you know this is the resistance level, you're supposed to enter the market straight from here. You are wrong, my brother. First, you're supposed to go and refine this structure to the lower time frame. Because, okay, for example, now we are using for our time frame. Now, you go to the H1 time frame first to see how is price doing around that level. And now you shift to the 30 minutes time frame. 30 minutes time frame, you go to see how price is reacting the structure. Is it price changing the structure? You could see on 30 minutes time frame, price change the structure before you could change the structure on the H1 time frame. Now you go to the 5 minutes time frame to see how price is reacting around that level. If you go to the 5 minutes time frame, you could see clearly that when price reaches this level, it rejects low, high, low. It rejects, give us this low, high, and this low. So probably we could see that our price gave us this new area of liquidity, which it is tested first before it flip this level. Now, after price flip this level, which means your entry now comes when price starts to retrace toward this area of liquidity and sell to the downside. That is how you're supposed to react. That is how you're supposed to take these structures before you anticipate any kind of a move. Okay. Now see, after price failed to respect this level, price was still maintaining swing highs and swing lows. Whenever price broke these swing highs and swing lows to the upside, would see those bullishness were not enough to hold this market, and you see price broke to the downside and continue going to the downside. The same thing. Now price is at this level. Now price is at this level. This is the level that's this is the liquidity level. Let me show you on okay, on we show you in so this is different. Let me show you yes, 2-hour time frame. Show you in 2-hour time frame. Time frame. Before price moved to the upside, we had yes, everything that we are talking right here. I will come, and I mean, when we reach its restaurant brand, I will explain everything. So when price reaching around this level, you could see this level. It was a level, and the characteristics of a level is for a level to be a level, it's supposed first to have these criteria. First, the rejections around that level. Price can come above this level, but the only thing that will differentiate between this between strong level and the weak level, it's does price close this above this level? No, price can cross below this level. Okay, fine. This is the strong level. Okay. Rejection and how price were crossing with this momentum candles. See how price was crossing above this level with a huge momentum. The same here. Momentum candle up, momentum candle down. Okay. Now, the same thing we'll observe around this level. It's either price will come and reject strongly and continue to move up to the upside, or price will close with huge momentum to the downside and respect this level and continue to the downside. Okay. Now let's try to look for other examples. On gold. So the same thing. You will define your market or your structure in terms of buyers and sellers, in terms of participants in the market, in terms of participants in the market. A good example is this recent market right here. Price give us high, low, high, broke this structure high, right? So it verifies that we are bullish. Then it gave us this high, low, this high, broke this structure high. What we expected is a price to come and close below this low, right? Everyone expected that price will come and break below this low and continue to the downside. But to our surprise, look how price reacted below that low. Yes, it validated the structure high. Yes, it didn't respect the structure low, which means it invalidated. So if price invalidates this structure low, we expect what? A change in structure, a change in direction. So if we're anticipating a change in direction, which means from being bullish to being bearish. Now look how price was reacting on this level. I said price, when it validates, you wait for it, you wait for price to give you a new area of validation, a new area of structure, then you use that structure to your advantage. But see how price was reacting around this level.